All right, good morning, everybody. After almost a decade of using the same headset, on Monday, I will be using a new one. Might have to do a little adjustments. Exciting times. I think this one's finally had it. Japan down 1.5%. We could see the US dollar Japan also kind of flattened out. Still a lot of talk about Hong Kong and the 2-year and how they're just letting it go. They're not even defending it this time. No intervention coming out of the China space. Small caps are flat and the NASDAQ up 0.25%. Still waiting for Spot Gamma to give us the founder's note, but the gamma levels have continued to fall since we topped out Christmas Day and the 27th. If you just read the PM edition, it's the purple line that's in the SPX historical chart at the top of the report. It's all those lines, cyan, yellow, pink, purple. Just keep your eye on the purple one each day as it's a representation of the gamma index, which right now is still pointed lower if you look at the PM edition. So we're waiting for the AM to see if it's bottomed out yet. Heard a lot of people talking this morning about the last day of the Santa rally and how this could give a boost to equities. They've been talking about every day it might be the Santa rally for the whole 7 days of the Santa rally, and we haven't rallied yet. So even if we get a dead cat bounce and happen to pop up some, I wouldn't attribute it to Santa at this point. We're going to get a Fed speaker today, Barkin. He's going to get replaced, right? He won't be a voting member because, they rotate out. So the new voting members in 2025 will be Collins, Goolsby, Schmid, and this other one. And they're going to replace Bosick, Hammock, Barkin, and Daly. So, yeah, he's going to come out chipping his teeth, but he really doesn't have a lot of influence. I wouldn't say discount any Fed member, right? They can inadvertently say something they didn't mean to say, move the markets, can have malicious reporting. He could just straight up get it wrong and say something that can move the markets. So when you have a Fed speaker out chipping their teeth, pay attention. And then late tonight, we're going to get auto sales. Not really a big deal on that one. It will already be done. ISM is the big one in the front end. And then out of Europe, we've got European Central Bank Lane is going to be speaking before Europe closes, which is a hint for you to be mindful as we get into 11 o'clock and then 11:30 with the EU close. Just watch the clock. Well, lay down or do something. Get out of the way. My cat has decided this month of December to just participate in these briefings. Get out the way. Cool. All right, so we're halfway back through yesterday's drop. If we just wiped everything off of the table here, take it from its lowest point to its highest point, you can see the halfback. We tried to peak above it and we weren't able to do that. There's the responses when we tested it earlier. So that is the level we have to get through. If we can get through it, we've got the ADR half, 59.57. There's a round number to deal with, which is what it looks like they took a front run on here, 59.50. So we got through the half, and before we were able to get to the options level, they took it back down. So that's the level we want to focus on. Just a little higher is this liquidity gap, 59.55. That lines up really well with the halfback. So this entire zone is going to be really difficult to get through, from 55 down to 50. And now that they've shown their hand a little bit, I would say just make it a little lower to this last low. That zone. Now, if you haven't come across it over the years, if you're dealing with support and resistance, you're trying to mark out your lines and levels, keep in mind it's not about some line that you drew in the sand with a very sharp pencil. It's more of a fat zone, like a dull crayon. So, it's not about 59, 55.75 to the very tick. It's more about this range or this zone of liquidity and being able to get through this level completely. So above this, we have that ADR half, and all of this is the level that we have to get through if we're going to continue that move to the upside. And it's a big if at this point, because we've been on pace for that consistent move to the downside where we make the drop on the intraday and then we rally back, giving back some of the drop, hold that through the Globex, make another drop, rally back. It's very consistent because that's what it's supposed to be, right? So here we ticked up a bit. This is where we started to base. Then we broke new lows. And it's the same thing. Down lower, pull back a little bit. This is the continuing narrative, and it's what markets do. If you flipped it over in the other direction, we'd be doing the same thing to the upside. So we've got the zone on the day that we need to pay attention to, and the liquidity gap from yesterday that we have to get closed. But if we take all of that off the table, we kind of look at it from a bigger picture. We've got this kind of a double top or a double bottom situation. That was the FOMC drop. We're back to the same place. There's the 111 where we reversed. Same spot. So if you've heard me say it before, double bottoms and double tops, they're traps. On the bottom with a double bottom, it's a bear trap. We expect to go lower than the previous low to convince the bears we're actually going down so that we can trap them. If we don't go lower than the previous low, we don't get any bears. We don't have anybody trapped. And then we don't get the very strong, sharp, sudden reversal that we want. We don't get the bears buying to close with the bulls buying to open. This sort of green, sharp filled rally with these big blue candles, that's the kind of reaction that we want to see when we've trapped a bear, right? When we had this low and we tested that low and we went lower than that low. That was a double bottom bear trap. This is trapping the bears and what it looks like when you've trapped them. It's fantastic. But that's not what we ended up with, because we didn't breach this low and get new lows. We didn't even get to that low, let alone get through it. And so this little push up stalled and it just didn't go anywhere because we didn't have any bears trapped in there. That leaves us for the situation where this is just another rally into resistance before we roll over and we make yet another leg lower, which puts us at 58.50. That's just the way it goes, right? Step by step by step. That 58.50 is also the ADR full. It's the yellow line down here. Now, this isn't guaranteed, right? Nothing is. If we can break our own Globex high and we can get higher than this high that we set yesterday, then we broke the pattern and we can focus on trying to rally back. There is this 786 level here, 58.58. Yeah, that level right there, which is the ADR half of today. If we zoom back out, when we've got this level, why is my drawer not drawing? There it goes. This is what we're measuring. That's the 786. If we want to make this like a big cup, even though it'd be a little weird at this point, we got to come back through and come back up again. That's the level that we have to get through. So that's more of a swing idea or a swing concept, that if we want to challenge the FOMC starting point and get that liquidity gap closed, then we've got to get through this 59.58. It's all step by step by step, right? And it starts with getting a new high in our own Globex, and then 59.50 and on up through. Dollar made some pretty good moves yesterday. It kind of freaked out global markets. As pulling back some, it's giving it back nice and easy. Yeah, the whole vote on the Speaker of the House, that's drama that we've seen before. In 2024, we rotated out of the Speaker because the guy wouldn't play the hardliner game. And that could really mess things up. And you're right, that is today also. So continue to keep your eye on the dollar. And remember, at this point, it's not about, oh, well, the dollar is ticking up, so I guess the ES is going to tick down, or the dollar is ticking down, so the ES will tick up. It's more about swag levels and where the dollar is. We need it back below 108. And as long as the dollar is still above 108, then that's putting pressure on equities in general. So we want to see that dollar softening, yes. But just because it is softening doesn't mean that we're going to see a rally in the S&P, the NASDAQ, the indexes, equities. We need it back below this 108. And so swift moves in the dollar in any direction is always bad. You don't want the dollar moving fast, no matter which direction it's going. Having said that, getting it back below 108 would be preferred, and the sooner the better. Just, we don't want it to look like a waterfall, because that'll also just freak people out. Energy continues to be a big deal, and it's still not a short play. So, when it comes to crude and energy, there's always a lot of conflicting interests, to say the least. And Japan holding where it did, this US dollar Japan, it topped out, and it's just been holding the line here, waiting on the 10-year to get caught up. This is a classic example of a correction in time. It moved really fast, and it just stalled out and stayed there, correcting in time, waiting for the moving averages to get caught up, right? Waiting on the mean, basically. Well, that has happened. So keep your eye on the 310 combo. We want to see price cut below the 3 and the 10, and then the 3 cut below the 10 if we're looking for a short. Otherwise, we want to see the 10 and the 3 hold, and then for US dollar Japan to break 158 and continue to the upside. Don't let that week and a half or 2 weeks or whatever it is, this range, don't let that convince you that this is weak. This is really healthy, and it's still bullish. It was a correction in time, just a good, healthy response after a big move. So until we cut below the 10 and we get the 3 below the 10, this isn't a solid short. Now you can LRE, low risk entry. It's not low risk because it's a high probability. It's low risk because the amount of money that you have to use for a stop is smaller. You can see the dollar did the same thing. It made a fast move, corrected sideways while it gave the 10 time to catch up. Once it did, it broke back above and continued the move. Right now, it's very likely going to pause again, digest, let the 10 get caught up. With the ES and the NASDAQ, we've been stair-stepping really nice. So if you're looking for that flip and rally for like a swing trade, it'll be the same concept that we need to base, let the 10 get caught up to us, jump that 10, then make a run to the upside and get the 3 back above the 10. The VIX still under 19. So as wild as all of this feels, it still hasn't spiked the VIX up. So we're under zero gamma. We're under the volatility trigger, the 10-week, the 3-week, the 10-day, the 20-day. We're underneath everything. We have a market maker move this morning, so they're hedging for something. It's hard to believe that they're measuring hedging for the market maker move this morning in ISM. So we want to see after 8:30 if this continues to grow. We got 15.92 in the front and then 12.45 in the back. So we want to see that front end fall lower than the next series out. There's the market maker move. So a run to the upside today is going to be fighting with that 10-week and the zero gamma line. And hopefully we'll get some clarity on where intraday there's positive or negative gamma. We can see the bigger level of zero gamma and that we're underneath it, so we're in a negative gamma environment. But on the intraday, there's always these little zones within the day of positive and negative gamma. So we just got to get the spot gammas report. So at 59.41 is still overhead. It matches up with our own Globex high this morning. That's the point of control for the current week and the level that we have to get through. If we can get through that, we got 59.50. We've still got 59.77, which is the value area high. If we can get through all of that, 59.92 cog line, and then 6,000 and 60.11, and then we got the cog line from last week. While it's technically possible, you know, we look at all this and try to ask, where's this fuel going to come from? Maybe it'll come from the speaker vote. Maybe one of the Fed speakers that are talking today, you know, end up sparking a rally. Looking at the central pivot range, today's pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. And it's worth noting we're holding the line this morning, just kind of sitting inside that channel, which is weird. We don't see price do this very often. when we do have price tighten up in a little range like this, that's not too uncommon. It's just uncommon to find it within the central pivot range. Price bundles up like this, it's waiting on something. And if you've gone through any of the RSI Laguerre material, we learned a lot about what markets do when they are like this. One thing that they do is they build up a lot of energy. So when we look at this and we say consolidation and, an inside day, or in this case, just building up a range, it looks like a raid and a draw. But what it's also doing is it's winding up energy like plugging your phone in, it's charging and it's full of juice at this point. And when a market makes a move, it can move with energy behind it, or it can move to get energy. If we're trending and markets are burning energy on that move up, they'll pull back really fast and they'll get energy from that pullback. So they gained energy in the move. Then they burned energy on the move. They gain energy on a pullback. And we know that from the RSI Laguerre. But another way that they can do it is just by sitting and going sideways like this. The analogy that I use is if you take a ball and you go out in the yard and you throw a ball, you put energy behind that ball. That's what made it move. And as it moves, it loses energy and it falls and it hits the ground. You take a ball to a really tall building and drop the ball off the top. As the ball moves, it builds up energy. It's the same ball, right? You didn't have to do anything special to it. It's just moving for different reasons. One is gaining energy and the other one is losing energy. Same thing with the markets. So when it does come out of this range, it's going to have a lot of energy behind it. And the question at that point is just going to be, well, which direction is it going to break? These central pivot ranges don't give us directional bias. Other than today's is lower than yesterday's, price opened underneath it, those are bearish biases, but it's still not giving us a direction. Good thing is we do have other information. So 59.11 cog line is the Globex low. We break that, we'll take yesterday's low. 59.41 is the Globex high. We break that, we'll take yesterday's high. I mean, that's pretty simple, right? All things considered. Short, sweet, to the point. If we get a new Globex high, we'll challenge yesterday's regular trading hours high. And if we get a new Globex low, we'll take yesterday's trading hours low. Outside of that, we would probably need a pretty good spark to get it, but I would look for a 1, 2, 3 flip off the bottom or a 1, 2, 3 flip off the top. Why not, right? $10-day, 30-minute volume profile, everything is right here. So if we can get above that 59.60 area, then we can use this as a supportive structure and begin slowly working our way back up through 6,100, 6,150 and into the middle part of the month. If we move away from this zone to the downside, then that's just going to be a solid ceiling that we have to fight through later. As long as we're holding within this zone, then we can cross back and forth through this zone. It won't be support or resistance. It'll just be us crossing back and forth through that level. We need to leave the range completely and then come back to it to see it act as a support or resistance. We got a new VPOC from yesterday. So another level that we have to deal with. That looks pretty good. So 59.48, it's not a surprise. It's basically 59.50. It's the options level we would already be paying attention to. That 59.11 cog line to the downside may help if we come back down and we revisit this Globex low. We can see some of that high volume node from yesterday may help out if we come back down and we retest that again today. I don't think we want to put it to the test though, right? It's kind of the idea. You can assume that the ice is thin without ever having to go walk out on the ice and see if it really is thin. So like we do every Friday, we have a peek at next week's range. Don't forget that next week is a short week because of the Carter burial, right? They're going to have the market closed on the 9th. Otherwise, next week is supposed to be a normal week in typical market calendar year. So I don't know that this indicator really grasps the logic that next week is a short week when it's an unscheduled week, but we can see next week's range and we can compare it to the current week's range. Just keep in mind that the next week's range isn't set in stone. It's going to move through the day today. And after 4:15 tonight, then it will be set in stone. So this is just a preview of what next week's range looks like. And so far, it looks like next week's range is wider than this week's range. Now, these ranges are based on volatility and time. If next week has the same amount of time in it as this week, then the only difference is how much volatility there is. This is a short week. Next week is a short week. So they got the same amount of time in theory. Not exactly right, because we had a short day and then a day off. So it's close. Big events suppress volatility, like FOMC suppresses volatility, CPI, non-farm payrolls, all of those big events. So seeing it widen out a little bit kind of implies we don't have any real big events on the horizon, which would compress volatility. We'll revisit this on Monday, see if it's widened out anymore or if it narrowed up before the week ended. We're 1% below the 10-day moving average. And while we've been lower than this is just about to the point where we would want to flip around and go back the other way. I know it's hard to see this as a wave, but these are waves. And we can see the blue line now is underneath the 0 line. We're going to be looking for it to turn and begin to move its way back up. But for that blue line to turn, we have to already be back above the 10-day, and we have to be far enough above it that it turns the 10-day higher. So it's going to take some time to get the blue line back above the 10. And that blue line is more about the health of the market structure and less about the day-to-day price action. It's not as low as it's been previously. We can see back in August, it was a lot lower. And looking at the 10-week, well, we're just getting started. Now, this generally doesn't give us one little tiny print. It normally, it lasts for a little while. So if all we're going to get is a little dip, then we'll be back above this thing, next week. If it's going to be like what we had through, this is 2024 right here. And through most of 2024, it was just a dip down and right back up. In August, when we had the carry trade unwind and the big VIX spike and everything got all wild, we spent 3 bars down there. Otherwise, it's just a dip down, and by the next week, we're back up again. Yeah, it's weird. We'll have to get that fixed. So every once in a while, Thinkorswim just does something goofy. Nope. So nat gas is down this morning, 4.5%, but it's still up 5%, 10.5% over a 5-day period. Bitcoin's down more than a half, but it's still up more than 1.5 in 5 days. And then things that are up, China, uranium, which reminds me, one of those SMR companies got upgraded this morning. CEG, Constellation Energy Corporation, which is one of those SMR uranium plays. It got an upgrade, making a big move this morning. But uranium's up. China, the FANGs, the Mag 7 group, bonds, chips. Same thing that we were talking about yesterday. If you want a rally day, these are the sectors that you want to see. The problem is they didn't stick when we got into the open yesterday. And some of the biggest moves to the downside came from that space. So we want to see this stick. With China up, that'd be Baba, Baidu, JD, PDD, XPEV, NEO, that whole group. We got pot stocks, precious metals. That move in bonds, there's still a lot of work to be done. If we're going to flip that over and try to run it back. At this point, it's not even a failed bear flag, right? It's just a bear flag. So it needs to fail first, then we can begin running it back up the other direction. 87 needs to hold. So if you're looking for like a line in the sand, that's the level that it needs to stay above. And from that, we can slowly begin working our way back up. But I don't think bonds are ready yet. And sure, I mean, uranium looks good. It started good yesterday, but we're only back up to the top of this cluster, and we've been to the top of this cluster through half of December. We kept going up there, hitting it. We got to get through it. I think this is the FOMC day. $29 is the line in the sand for uranium that we have to get through if we're going to try to get back up to these previous levels. It says semiconductors are up this morning, but that's a algo print more than anything else. We don't have any real flows in there this morning. That needs to change. So it looks good on paper, but just like yesterday, there's no substance to this yet. See, that's more than an algo print, right? There's actual candles there. We can see two-sided trading. There's actionable trade activity. Not something like this, where we've just got this little dot here, and it says that we're down 1.5, 1 3/4. That's just an algo print. We want to see more than that. Keep your eye on the VIX today. I think if anything is going to start getting wild today, we may finally see them take the reins off of the VIX and let it run. It's been very muted. That may be one of the things that needs to change. So we got a whole lot of market this morning not hitting our benchmarks of 0.5%. It's not down a half, it's not up a half, just toeing the line. Three names in the S&P are down 0.5%. 17 names in the S&P are up at least 0.5%. So 17% of the S&P is up 0.5%. That's not overly bullish. And the names that are in there, a lot of finance, which makes sense if you've seen the 210 spread. And then chips. See a lot of these chip names. It's not overly bullish when you see it from that point of view. Now looking at the NASDAQ, 28% of the NASDAQ is up 0.5% or more. Packaged software and chips. Now that's a dichotomy we haven't seen a lot in the later part of last year. We were getting chips or we were getting software, but a lot of days we weren't getting both. This morning we're getting both. Well, kind of like that. It just needs to stick. So IGV versus SMH as your pairs trade. If we're going to run, this would be a good start, and then we can have the options come in later in the day to add some fuel to the fire. So it'll be the NASDAQ. If we're going to run, I'd look for it to start there. That's what I got for you guys. Have a good weekend. Be careful, be safe. I will see you all next week.